Good evening, everyone. Welcome to Petron live sharing class. So once again, it's my greatest honor to be able to share with everyone here. Hope everyone in my class are able to pick up some knowledge from my sharing and able to fully understand the materials. Please also take some time to read up again if you guys have any doubts, and also put the knowledge you have learned in my class into practice. Continuous of learning and practice will definitely improve your trading skills, which will eventually leads to profitable trades. As I mentioned many times, financial freedom is our ultimate goal. So let's work hard together to achieve it. As for today, there's a new topic I would like to share with everyone, which is gap theory. The contents I pick to share with everyone, I always believe is useful and important for most of our friends. This technique is able to help everyone to have a clearer picture about how to read the charts. My job here is not only to share trading techniques, but also here to scan for more profitable high quality stocks, share market analysis, and guide everyone in all aspects of trading. So, I hope everyone in 2024 can be more skillful in their stock trading and gain more profits in their trades. Thank you everyone for your support. Okay, let's move on to the contents, what we are having for today. So today we have 5 contents. Okay, let's move on to our first market analyst, which is the Nifty 50 index for the weekly chart. As for this week, the Indian stock market should be very impressive, especially when the US stock market is relatively sluggish. We saw consecutive gains on Thursday and Friday, which was quite remarkable. It can be said that any investors in the Indian stock market would welcome and love such performance. As a market participants, we also feel very honored. Okay, let's take a look closer into the chart. Okay, the chart for Nifty index. This is the first trading week for 2024, which shows great significance. Although the index has not risen according to the candlestick chart, but in reality, the performance of the Indian stock market is very strong on a global scale. Since the week has ended, today I will review and analyze the weekly chart with everyone. From the weekly chart, we can see that the current upward trend is holding up very well. The weekly chart for this week closed with a doji. Okay, you can see at the top here, which is a kind of adjustment during the uptrend. Usually a doji candlestick represents a temporary balance of the power between bulls and the bears. The uptrend since the end of last year, October, has been very strong. From a technical perspective, we can clearly see that the weekly MA5 is pushing the price up, and the angle of the MA5 itself is very healthy and smooth. As I shared before, regardless of the time period, MA5 can be used as a reference for judging the smoothness of the uptrend of the market. Next, let's take a look at the MACD indicator. The fast and slow line of the MACD indicator have formed a golden cross, which is above the zero axis. Okay, which is here. And the distance between the fast and slow line is increasing. Although the candlestick chart closed with a doji this week. The divergence between the fast and slow lines is still expanding, which is strong characteristic by itself. Although the index has remained strong, attention needs to be paid to it is charging rhythm. The index has transitioned from the previous explosive rise to a currently channeled rise, with a significant difference pace of increase. This can be seen more clearly if you take a look at the daily chart. Okay, so we move on to the next one, will be the Sensex weekly chart. Let's take a look at the weekly chart of Sensex. In fact, the chart of the Sensex index at the weekly level is even more similar to the Nifty index. So let's briefly discuss about Sensex. The index is also supported by the weekly MA5 for uptrend. At the same time, the fast and slow line of the MACD index are diverging, indicating a strong phase in prices. Currently, whether it's the candlestick pattern or various trend indicators, all indicates the bullish progress of the stock market. Since the rise from the end of October until now, it has been maintained for 10 consecutive weeks, with virtually no price pullback during this period. Although the speed of the rise is starting to slow down, it is still considered very healthy. As trend followers in the market, we should continue to follow the trend. Okay, let's move on. For microanalysts, next we'll go focus on microanalysts, which is the data and the news. The key point about reading up on news and data, as I mentioned before, is how investors interpret the news or the data. The same data or news may be viewed by same person, but they have a different thoughts on their mind. So analyzing macroeconomical fundamentals can help investors identify long-term investment opportunities and capture long-term trends in industry and the economy. In this sense, in our usual trading process, we only need to pay attention to the stocks themselves, but also to microeconomical fundamentals. Okay, let's see what news I prepared for everyone. As for today, I prepared two news. So let's start with the first one. According to the first advanced estimate by the National Statistical Office, the actual GDP growth rate for 2023 to 2024 is projected to be 7.3%, while 2022 to 2023 is at 7.2%. India's growth rate, driven by increased government spending and significant expansion in manufacturing activities, place it at a forefront of the world major economies. The economical recovery is attributed to proactive measures taken by the Indian government, including expanding expenditure on critical infrastructure projects. Prime Minister Narendra Modi focus on promoting economic growth is reflected in initiative to increase investments and stimulate manufacturing, contributing to the country's economic recovery. Meanwhile, India's strong performance in the September quarter with a year-on-year economic growth of 7.6%, exceeding expectations, has bolstered confidence in its ability to sustain robust growth. This expansion follows a growth of 7.8% in the previous quarter, prompting some private economists to revise their annual forecasts in anticipating of continued strong economical momentum. Despite global economic uncertainties and challenges, India's growth trajectory stands out and receives further support from favorable forecasts by international institutions. Standard & Poor's Global Ratings expects India to maintain its position as the fastest growing major economy in the next 3 years, and anticipate it to become the world's third largest economy by 2030. While the global economic landscape continues to evolve, India's ability to surpass other countries reflects a combination of prudent fiscal policies, strategic investments, and a resilient domestic market. India's robust economic development not only provides strong momentum for the market, but also continue to attract an increasing number of investors from around the world. Okay, let's move on to the next news. According to the data provided by NSDL, foreign portfolio investors, which is FPIs, continue to buy in their buying spree in this first week of January. They have total invested around 4,773 crore in India stocks. In December last year, the domestic stock market benefited from strong inflow from FPI, with a whopping 66,134 crore being infused. The Nifty rose by nearly 8% during last month. So, in December last year, the FPI were major buyers in the financial services and IT sectors, and also purchased in industries such as automobiles, capital goods, oil and gas, and telecommunications. Of course, objectively speaking, while FPI provide a significant amount of incremental capital to the market, the upward trend in the stock market is certainly not solely due to FPI large purchases. The trend in the stock market is the result of combined market forces. One reason for FPI's substantial investment in India's stock market is the significant decline in US bond yields and the weakness of the US dollars. Additionally, India's robust economical growth is also one of the most important factors. Furthermore, the further decline in US interest rates could increase their buying in 2024, especially in the initial months before the elections. With large cap stocks being primarily beneficiaries. Okay, that's all for our news for today and data. We will move on to the next topic. Okay, Asia Pacific headquarters. As many friends are very concerned about the progress of the asset management skill contest among the top 3 in the Asia Pacific region. So I have come up with the data and I will share with everyone. So thank you for all your support. And now let me share with you, everyone, with the current result. As of last Friday, 5th of January, the result of the asset management skill contest are as follow. You can see on the screen, which is for India, we are currently at 623 million pound. And for Japan, they are at 851 million pound. And for Hong Kong, which they are highest for now, they are at 922 million pound. So, although India currently is in the 3rd place, which is not a very good news for me, okay, I'm not quite pleased with that, but we will work hard together, okay. So for currently we are in 3rd place in the asset management skill contest. My team and I still feel very confident that in the past week, our trading of the UC limit stocks has achieved an overall return of 25%. Looking at the 15 high quality stocks we are currently tracking, we expect a return of the rate for the next week to be no lesser than 40%. This means that we have the opportunity for a substantial increase in our asset management skill next week. Therefore, I urge all members to prepare funds for trading in advance. If we manage our overall profits, trading profits well for next week, our asset management skill has the opportunity to surpass Japan and Hong Kong. Looking at the expected market condition tomorrow, our UC limit trading targets in the afternoon will not only have the opportunity to achieve a 10% return on Tuesday, but also have a high probability of consecutive UC limits situation next week. Therefore, I urge all members to prepare funds for trading in advance. Due to the relatively limited daily entry amount for our foreign asset management accounts, please look for my assistant, okay, and register to reserve the entry amount for next week. Of course, the purchase quota for this high quality UC limit stock tomorrow is also relatively limited. I just went through some of the data. Therefore, at tomorrow, 2:30 p.m., I urge all members to make their purchase as soon as possible and on time to avoid being able to purchase a partial quota only due to insufficient funds. It is even possible that members who purchase late may encounter a situation where the quota for the day is already taken up. Okay? Okay. Currently, in the stage of competing in the asset management skill, we still mainly focus on trading with the UC limit stocks. However, I want to share another piece of good news, which is on January 19, there will be a launch for IPO of Additive Learning Technology. As my team and I conducted a large amount, okay, we do a lot of research on and investigations on this company at the early stage. We have confirmed that there is a high probability of at least of 80% the yard in profit in the initial stage of listing. Currently, we are also negotiating with relevant institutions for underwriting quotas. Once we are able to secure the corresponding underwriting quota, the funds of all members who are successfully allotted shares will experience a substantial increase. This will also lead to an explosive growth in our overall asset management skill. I will inform everyone in a timely manner once the underwriting quota is confirmed. Of course, as a foreign institutional investors, our foreign asset management accounts also have a unique advantage in subscribing to new stock like IPOs. I'll share more details at a better time. And please pay attention to the content shared in a group, okay, in our group chat, and in our live class. Okay, please attend our live class. Okay, as for this slide, currently in the context of the asset management skill, our main focus is still on trading on stocks that have UC limits. Since we started trading these stocks, our total yield has reached 85%. In the past week, our overall trading of such stocks has also achieved a yield of 25%. Therefore, even though in the first week of the asset management skill contest, we are currently in the third place, okay, for India. Both my team and I are still very confident that our asset management skill contest only runs until February 23rd. So we still have enough time to catch up. Here, on behalf of Ventron Ventures, I would like to express my gratitude to all the members who have supported me. It is because of everyone's support that my team and I have the confidence with all of that we can do it. It is also everyone's support that my team and I firmly believe that we will win this race. Okay? As people in many countries around the world say that India is a country that values teamwork. And it also seems to me, I value teamwork. I believe that no goal is unattainable as long as we are united and work together. Therefore, I entrust everyone with your support, and please entrust stock trading to me and my team. We will definitely select the best stock to bring to everyone more opportunities for asset growth. Okay, let's move on to classical tactics. This is one of the things that I would like to share with everyone. Okay, we'll continue to share the classical tactics with everyone. Today, we are going to share this theory called gap theory. In fact, some friends have often asked me how to learn about gap, which is in the chart. Okay, there's a few times we see a gap up or gap down. Okay, so today I will share with you in a more systematical explanation. Of course, some friends might have never understood this aspect at all, whether you have or have not understand the gap theory, it doesn't matter because the content I am sharing today is mostly based on my own years of experience, okay, my own practical years of experience. Although most of the content is my own summary, the gap theory does not have a great universal in the market and strong practical significance. So let's start. What is gap theory? How do we apply in trading? Let me share with you in more details in the next few slides. Okay, when it comes to the theory of gaps, we will study it from 4 different aspects. First, what is a gap? It refers to understanding the nature of a gap and underlying principles behind it. This understanding is essential and proficient application. 2, what is the significance of gap? Okay, for this, I will share in the next few slides. Number 3, what are the different forms of gaps? Meaning that this involves in categorizing and understanding the various classic types of gaps. Okay, it's also will be shared in my next few slides. And point number 4, how can the gap theory be applied in actual trading? Regardless of the theory or technical, the ultimate goal is to apply them in practical. Okay. Therefore, how can we use all these gap theories? I will share with you. Okay, let's move on. Okay, the first question. What is called a gap? Okay. The so-called gap is the candlestick chart. Refers to the phenomenon that due to the influence of positive or negative news. See, I talk about news, okay? The stock price rises or falls sharply, causing the lowest price of the day to exceed the highest price of the previous trading day, which is called gap up. Okay, gap up. Or the highest price of the day is lower than the lowest price of the previous trading day. This is called a gap down. Okay, maybe the description in words is a bit difficult for everyone, but it's very clear when you look at the figures. Okay, the part marked with a box, okay, you can see from the box here, these 2 boxes, which is one is gap up and one is gap down. Okay, you can take a look from here, you can see, okay, this gap up and this gap down. Obviously, a gap refers to a price range with no active trading activities. If trading activities occurs in this price range in the days following the appearance of a gap, that is, if a candlestick appears in the price range, this is called gap fill. Look at the chart. Everyone can see that after this price get up, okay, the price fall again. Okay, let's move on. You can see from the fall again. Okay, so let's move on. Okay, for the second question, what is the significance of the gap? First of all, the gap can reflect the change in the market sentiments. The formation of a gap up is mainly due to the opening price being much higher than the previous trading day closing price, and the ability to open high indicates that the market or the main force has already determined the intention to push up before the opening. Therefore, the first match after the opening directly opens at a higher price, indicating that the main force initial is very obvious. That is, to prepare to enter the market for large purchases and push up the price. Therefore, we see that the opening is very high. Okay, you can see there's an opening that's very high. The gap. Creating a large gap, okay, over here. Since our stock market is in a super bull market, so I'm not going to explain the gap down, okay, because most of the chart is gap up, okay. So let's move on to the next chart. Okay, the gap can also serve as a support and pressure for prices. A gap occurs only when the main force agrees to sell before the market open. So we can consider the upper or lower edge of the gap as a signal when the main force buying or selling. Okay? It is seen as a strong resistance or support. As long as the gap is broken upwards, it usually indicates a strong possibility of price increase. Conversely, if there's a gap down, okay, so but for gap down, we didn't explain much, right? So I will not touch on the gap down, okay? Studying the reasons behind the formation of the gap from perspective of the market behavior and the market psychological is more conducive to our trading decisions. These trading decisions are based on market trends. For example, a strong gap up indicates that the mainstream trend is the current market is upwards. So, why wouldn't we follow the trend? Of course, there are also some special cases, okay, which will be discussed later. Okay, for this slide, let's take a look at various forms of different gaps in the market. As we know, there are many kinds of different kind of gaps. Usually, according to the gaps generated in different stages of the market, they can simply be divided into 4 different kind of forms. Okay, first, we call it breakaway gap. Okay, breakaway gap is the price rapidly move in a certain direction, breaking away from the original pattern to form a gap. The appearance of a breakaway gap indicates that there will be a significant market outbreak in the future. Typically, when the gap occurs, there is a large trading volume and the price is not filled. The larger the gap, the greater the future velocity. Therefore, the analysis of breakaway gaps of a great significance. For number 2, continuing gap. It appears that trend markets occurring after a consolidation phase with a large trending volume and not fill. It indicates that the trend will continue. Okay, for number 3, which is absorption gap. It appears at the end of the market trend, jumping in and upwards, or downward trend but quickly being filled. The study of this type of gap has a significant practical of our actual trading. And the last one, which is called common gap. The analyst value of a common gap is relatively low, generally referring to a gap that occurs accidentally during a period of consolidation and a quickly fill, with little impact on the trend analysis. As for the above types of gaps have been shared with everyone, next let's take a look specifically that each type of gap, how do we use it, okay, or learn it. Okay, just now I mentioned the first one is breakaway. So, what is a breakaway? Okay, so you can take a look at the slide. When the price rapidly moves in a certain direction, breaking away from the original pattern. Okay, which is the pattern was original like this. So you break away and go up. Okay? It's called and this gap called a breakaway gap. Okay? The appearance of a breakaway gap indicates that there will be an explosive market trend in the future. The larger the gap, the greater the future volatility. Therefore, the analysis of a breakaway gap is of a great significance in actual trading. Okay, you can see this is the normal, okay, the normal trend, but with a great breakaway, it become a higher and explosive uptrend. Okay. Okay, market trends generate by breakaway gaps like this are actually a source of profit. So all friends, let's think about it. If we can skillfully apply the gap theory, we don't need to earn all the profits. From this trend, it's enough. From this trend you can see, okay, even we can earn portion of the profits, it will be a very good trade. Okay. High stability and certainty, almost like picking up money. Okay. This trade, if anyone who do this trade for this breakaway, I can guarantee the investors has made quite a sum of money in this trade. Okay, so this is what we call breakaway. Okay, breakaway gap. Okay, let's move on to the next one. Continuational gap, okay, refers to a gap that occurs during an upward or downward trend. Continuational gap usually forms between the beginning and end of the period of intense price fluctuation, typically without a price recovery, which indicates that the trend will continue. The difference between continuational gap and a breakaway gap is that before the appearance of a breakaway gap, the market is usually in a state of oscillation, while a continuational gap appears when there is already a clear upward or downward trend. Looking at the chart, you can see it at a clearer picture. Okay, you can see here, there's two. This type of gap reflects the market's smooth development with moderate trading volume. In an uptrend, the appearance of a continuational gap indicates that the market remains strong, while in a downtrend, shows that the market is weak. Okay? So this is continuational gap. Okay, let's move on to the next one. Exhaustion. Okay, let's take a look at exhaustion, which is the third type of gap. This type of gap is quite significant in practical terms, and it holds an equally important position as a breakaway gap. Okay, while the breakaway gap indicates the entry point, the exhaustion gap signal the exit point. One is entry, okay, one is exit. Okay, which give you a sell signal. Okay, the exhaustion gap occurs at the end of the market trend. When there is a gap in the upward or downward trend, but it's filled quickly, usually the stock price makes a final jump in the midst of significant fluctuations. But this last struggle is short-lived, and in the following days, the price immediately begins to decline or rise. The appearance of this gap warns us to be cautious. The previously smooth market situation has shown abnormal movements. As in practical terms, our first reaction should be consider exiting or at least reducing positions to lock in profits. A look at the accompanying chart make this what I explained a bit more clearer. Okay, as I say, at the end of the trend, right, exhaustion, which is a sell signal, and it goes down. Okay, so this is an exhaustion gap. Okay, let's move on to the next one. The last one, the fourth kind will be common gap, or we can call it ordinary gap. Okay, without any research values. Okay, for the analysis of value for common gap is relatively low. It usually refers to occasional appearance of gaps during consolidation and quickly fill. They are filled very quickly. It does not have much impact on the trend analysis. Take a look at this chart. You can see that the circle part is all the common gaps. Okay, but it's filled very fast. Okay, but this type of gap does not provide any assistance in the practical operations, meaning doing our trading, and does not need to further study. Okay. So, sorry, I think I skipped one or two pages. Okay, let's continue with this. We explained in details about the four gaps just now. Okay, as I mentioned, no matter what tactics or theories, they must ultimately be applied to actual tradings and must be tested in actual tradings. So, how should the gap theory be applied to actual tradings? In terms of actual trading values, breakaway gaps and exhaustion gaps are the most practical. Because in general, as long as a breakaway gap occurs, it often heralds the outbreak of a market trend. The reason of exhaustion gaps have a higher practical value in this type of gap is usually determine the end of a market trend, which is telling us to sell away our stocks. Okay. As for common gaps and continuational gaps, their value is actually relatively small in trading. Okay. So let's take a look at the next slide. Application that breaks through the gaps. So let's take a look at the practical applications of breaking through. As usual, we will use graphical examples to explain. Okay, take a look at the graph. Okay, the part that I circle in the graph is a standard. It's a breakaway. Okay, it's a breakaway. So for a breakaway, as I mentioned just now, it's a buy signal. Okay, and the trend will go upwards, right? So before this gap appear, the market clearly shows that it's fluctuating over here. Okay, although this gap in the graph is not a large one, it's significant and it's obvious. Why? But so pay attention. Firstly, the gap has not been filled. Okay. Secondly, the opening price is the lowest price. Meaning that after the market opened, the price did not return below the opening price. Therefore, from this perspective, although the gap space is not large, it still represents a strong bullish intent, making it a standard buying signal. As for specific timing of buying, when to buy, for those who are expert, the day the gap is formed can be considered as a buying opportunity. But for most of us here, I do not recommend to buy on the same day. It's best to buy on the next day, because we can observe the gap. Okay, we can observe the gap more specifically and study the meaning behind it, thereby increasing the accuracy of our trading. Of course, once your trading ability reach a certain level, then this no longer applies. You can buy on the first day. Okay? So let's take a look at the next slide. I say that among all the gaps, only practical significance of breakthrough gaps, which is the breakaway gaps and exhaustion gaps, is the greatest. Okay, we like them the most. Okay, because they help us a lot. We just talked about the application of the breakaway gaps, and now let's take a look at the exhaustion. So, similarly, using a chart also, I'm using this chart to explain to everyone. You can see on the chart, okay, which is here, which I have marked, to determine the exhaustion gap. First, there must be a clear upward or downward trend before the appearance of this gap. Okay, it's up. Okay, you may have noticed that all my examples are based on rising cases, and the reason is that in the stock market we only go long and not short. Okay, I never recommend to everyone to do short. Okay, I only recommend everyone to go long. So of course, just relying on the above points is not enough to determine an exhaustion gap. So in general, after the formation of this gap, we also need to observe the trend, okay, of the market in the following trading days. If the sustained gap, then is in subsequent days there should be a sustained rise. However, in this chart, after the gap is formed, it's basically oscillating at high level, which is over here. Okay, when it's formed here. Okay, we can basically determine that this is an exhaustion gap, and we should know that this is a sell signal. We should seize the opportunity to sell the stock at a high level. You see, oscillating, sell, then you go down. Okay? What if the price continue to rise after selling the stock? Some guys might ask, here oscillating, then go up, right? Rise up. I can clearly tell you that after selling the stocks, there's no need to hesitate. On one hand, the profit has been locked in. You already make profit. And on the other hand, there are many other trading opportunities in the market. And there is no shortage of opportunities like this. Meaning, you already sell your stock and gain the profit. Why do you need to look back into this stock again? Go on to search on better stocks. Okay, I will share more stocks with you guys. Okay, let's take a look at the next slide. Okay, this is, as I just tell you, it's a common gaps. Okay, so pay attention at this chart. Okay, there are so many gaps, but they are pointless. Okay, show no clear direction or indications. So we usually do not really need to study these kind of gaps. Okay. Okay, let's move on to our stock analyst. Today, for this week, we have taken profit from 2 of the previous recommended stocks. And we believe that those who follow have also reaped corresponding profits. With a serious and responsible attitude towards the stock we recommended, me and my team will continue to track and observe them, okay, and track until everyone exit and take profit. Okay, let's move on to the individual stocks. Okay, the first one will be Infosys. Okay, Infosys Limited, which is a global technological service company, okay, and the second largest software exporter in India. On Friday, the stock shows a strong rebound, surpassing its previous high and completely erasing the adverse effects of Wednesday's decline. From a technical perspective, the price adjustment on Wednesday just touched the support line before rebounding. According to Dow theory, okay, you guys have learned before, the stock has formed a new upward trend as each successive high and low points has been higher. 3 days ago, JP Morgan upgraded Infosys stock from natural to overweight and raised the target price to 1,800 rupees. Therefore, the price adjustment on Wednesday is highly likely to be surpassed by the main institutional investors in order to buy more shares at a lower price. As for the future strategy for this stock, and it's advisable that to continue to hold it, okay, for those who have already sold the stock, do not need to repurchase it, okay, do not purchase it now, but can wait, patiently wait for other trading opportunities, okay, when I will share with you, so you can purchase other stocks. No need to repurchase this stock. Okay, let's move on to the next stock, which is Saregama. Okay, let's take a look at Saregama. Okay, last year, its revenue increased by 28.38% to reach 79.025 crore in rupees. The industry average revenue growth rate in the previous fiscal year was 7.32%. The growth in digital revenue and the increase in paying users have ensured the company's long performance growth. Technically, after a rebound in the past few trading days, the current stock price has entered a narrow range of fluctuations, with a range of fluctuation compared to the previous period narrowing. However, its price central is still slowly moving upwards. Since the adjustment, the low point on December 22nd, an upward trend can now be drawn from the below, with successive higher peaks and troughs appearing. It is difficult to expect another decline. The current stock price is just near our recommended price, meaning there is currently little to no room for larger profits. Okay? And what we need is a little patience. Okay, just be more patient, guys. For the stocks, I personally recommend is to continue to hold for now. Once appropriate time comes, we will notify everyone to sell the stock at the earliest opportunity. And for the last stock of the I'm going to talk about is Star Health. Okay, regarding to Star Health, as we all know, it's the first independent health insurance provider in India, and is also one of the largest private health insurance company in the country. After a rising of about 10 days of trading, the stock price experienced a downward adjustment, which is on Friday. However, this adjustment is not necessarily negative. We can observe that the stock has been gaining strength since hitting a bottom on the 21st of last month and has already broken through the recent downtrend line. The price adjustment on Friday can be seen as a confirmed action following the breakthrough. Once this confirmed action is completed, the stock price is expected to rise again. Okay? From a technical perspective, the past few trading days have been a confirmation of the bottom, indicating a secondary retest with support gained from the bottom. After the previous round of outward rebound, it is foreseeable that the stock will not experience a significant decline. I would like to mention that we will continue to monitor this stock very closely. If there's any other unusual movements in this stock or the opportunities to sell, we will notify everyone at the earliest opportunity. Currently, the company is operating normally, and my personal recommendation is also to continue to hold and observe this stock. Okay, we come to the end. Okay, friends, today our sharing class will end here. And thank you very much for joining my class and giving me your support. We will continue our live class on this coming Tuesday on 9th of January 2024, 8 p.m. Okay, I hope to see everyone here. And thank you once again. Have a good night.